Welcome to Summed Up Books. Today, we are diving into an absolute game changer in the world of finance, The Little Book of Common Sense Investing. Its author, John C. Bogle, actually founded Vanguard based on a super simple yet incredibly powerful idea about how to build wealth, and we're going to break down exactly what that is for you. This one quote, it's pretty much the heart of Bogle's entire philosophy. He's saying that investing is supposed to be a winner's game. Think about it. Businesses are designed to grow and make money for their owners over time. But for most people, it just doesn't work out that way. Something goes wrong and it turns into a loser's game. So in this explainer, we're going to figure out what that is, and more importantly, how you can flip the script. All right, here's our game plan. First, we'll look at Bogle's winning formula. Then, we're going to expose this loser's game that so many investors get trapped in. After that, we'll reveal the simple solution, uncover the big psychological reason why people don't use it, and then wrap it all up with some clear takeaways you can use right away. Okay, so let's get right to the core idea. Bogle argues that winning at investing isn't about the excitement of trying to pick the next hot stock. Nope. It's about something way more basic. Just owning a piece of all businesses and being absolutely relentless about cutting the costs that chip away at your money. It sounds totally backwards, right? The entire financial industry is built on doing stuff, on trading, on picking stocks, on beating the market. But Bogle asks this radical question. What if all that activity is the very thing that's actually holding you back? To really get why, we need to see how the game is kind of rigged against you. So, what exactly is this loser's game? Well, Bogle explains that the system most of us are in is basically designed to make the financial industry rich, not you. And he uses this simple, absolutely brilliant story to prove it. So just imagine this family. Let's call them the Gottrocks. They are incredibly rich because, as a group, they own every single company in America, the whole pie. Every year, they just sit back, collect all the profits and dividends, and their wealth just grows right alongside the U.S. economy. Simple. But then a bunch of helpers shows up. Brokers, fund managers, financial advisors. They start whispering to individual family members saying things like, hey, I can help you get a bigger slice of the pie than your cousin over there. They get them all excited about trading stocks back and forth. And for this service, the helpers just take a little fee. So a year goes by and the family gets together to look at their total wealth. Now the pie itself, the value of all those American businesses, it got bigger. But the family's share of that pie, it actually got smaller. Why? Because every single dollar they paid to the helpers came directly out of their own pockets. The more they traded, the more they paid, and the less they actually kept. And that's the whole lesson right there, summed up perfectly by Warren Buffett. All that activity, all that motion, it didn't create any new wealth for the family as a whole. All it did was drain money away to the middlemen. The helpers won, and the family, as a group, lost. So how much does all this motion cost us in the real world? Bogle figures the total, all-in cost for a typical actively managed mutual fund can be around 3% a year. Now, that might not sound like a lot, but listen, this isn't just the fee they tell you about. This is the hidden trading costs, the sales charges, all these other little expenses that are quietly eating away at your money year after year. This chart just shows you the damage perfectly. So let's say the market goes up 10%. After all those costs, the average fund might only give you 7.5. But here's where it gets even crazier. Because we investors tend to chase what's hot and then panic and sell when things get scary, our actual return is even lower than the fund's. Over a lifetime, that gap is the difference between a comfortable retirement and, well, not. And this is where Bogle's logic is just undeniable. Before you factor in any fees, investing is a zero-sum game. For every person who beats the average, someone else has to lose to the average. It all balances out. But the second you subtract the costs of playing, those fees, those commissions, it becomes mathematically a loser's game. As a group, all investors must underperform the market by the exact amount of those costs. It's just simple arithmetic. Okay, so if trying to outsmart the market is a guaranteed loser's game, how in the world do you win? Well, Bogle's solution is brilliant. You stop playing their game and you start playing a completely different one that's way simpler and way more profitable. First thing you have to realize is that there are really two markets. You've got the real market, that's the slow, steady world of actual businesses making things, earning profits. And then you have the expectations market. That's the wild, day-to-day chaos of the stock market, driven by emotion, news headlines, and pure speculation. The secret is to completely ignore the expectations market and focus only on the real market. And here's the proof. I mean, look at this. Since the year 1900, the stock market has returned about 9.6% a year. But where did that return actually come from? A whopping 9.5% of it came from the investment return, the actual dividends and earnings growth from businesses. And the speculative return, all the market hype and emotion, a tiny, basically irrelevant 0.1%. The lesson is crystal clear. Over the long haul, business reality is the only thing that matters. So how do you own that real market? It's simple. An index fund. An index fund doesn't try to be clever and pick winning stocks. It just buys all of them, the entire market, like the S&P 500 or even the total stock market, and then it just holds on. Bogle's famous analogy is perfect. Stop looking for the needle in the haystack. Just buy the whole haystack. Okay, but wait a second. This brings up a huge question. If the solution is this easy and the math is so clear, why doesn't everybody just do this? Well, according to Bogle, the biggest obstacle to our own success isn't the market, it's us. This number is it's shocking. Between 1980 and 2005, research found that the average investor did worse than the very funds they owned by 2.7% per year. And that huge penalty comes from our own bad behavior. We chase funds that are already hot, and we sell in a panic when the market drops. We are, without a doubt, our own worst enemy. The real problem, the core behavioral flaw, is that we get fooled by randomness. We mistake luck for skill. When a fund has a great couple of years, we convince ourselves the manager is a genius who's going to do it again and again. We see a pattern in what is really just random noise, and we chase it, almost always right off a cliff. This chart is a perfect example of something called reversion to the mean. Back in the dot-com bubble, the top 10 funds were rock stars, averaging a 55% return every year. Investors poured money into them. But what happened in the next 3 years? Every single one of them crashed and burned, ending up at the very bottom of the performance rankings. The hottest funds became the absolute worst. Past performance wasn't just useless, it was a trap. So if the evidence is this overwhelming, why do we keep doing it? Well, it's a combination of our own emotions, our greed when things are good, our fear when they're bad, and a multi-billion-dollar financial marketing machine that is constantly screaming at us that we can beat the market if we just buy their latest, greatest product. It's a powerful and very expensive delusion. And that brings us to the final and most important part. Now that we understand the problem and we know the solution, here is the simple, actionable formula to put all of John Bogle's common sense into practice. All right, here it is, Bogle's winning formula in 3 simple steps. Step 1, own it all. Just buy a low-cost total stock market index fund. Step 2, keep costs ridiculously low. Choose funds with the absolute lowest expense ratios you can find, because cost is the one thing you can actually control. And step 3, stay the course. Now, this is the hardest part. You have to hold on, ignore all the noise, and just let the magic of compounding work for you over decades. In the end, it really all comes back to this. It's not about being smarter than the next person. It's about having the wisdom and the discipline to just accept the market's return, slash your costs to the bone, and patiently, stubbornly stay the course. That is how you win the winner's game.
If this explainer gave you a new perspective on investing, do me a favor and hit that like button. And be sure to subscribe to Summed Up Books for more. You can grab your own copy of the Little Book of Common Sense Investing using the link in the description, or you can even get it for free with an Audible trial. Thanks for watching. Click, learn, repeat.